So this is a brand new paper, and it's not publicly available yet. I presented it for the first time in Tel Aviv last week, and I'll be happy to share it with any of you who may be interested in it. Just shoot me an email and I will send you a copy. So basically, this goes back to stuff that I did maybe 12 years ago, where I published an article on globalization, tax competition, and the fiscal crisis of the welfare state, which seems pretty appropriate today given what we're talking about. And basically the idea was that in the current age of globalization, as opposed to the previous one in the 19th century, capital is much more mobile than labor. This leads to a gradual shifting of tax incidence from capital taxes to labor taxes, but eventually, essentially, you run out of your ability to squeeze more taxes out of the labor, and therefore the result is revenue shortfalls to the government, and you have to cut the welfare programs. And this, in fact, may be what, to some extent, is happening in Europe now, because they are cutting. And they really are, I think, pretty much maxed out in terms of their ability to tax labor. I mean, if you think of a country like Sweden, for example, the top income tax rate is 56.6. There's a 25% VAT on top of that. I'm not sure that you can do much more than that. François Hollande in France is proposing a top income tax rate of 75%. We'll see how successful he is with that. It's an interesting experiment. I mean, the basic issue, of course, is that in Europe, your borders are completely open. I mean, there's no immigration restrictions whatsoever, and people are really free to move from one country to another, and it'll be interesting to see how people respond to these increases. So this new paper has a somewhat different thesis, however, and that is that as far as the US is concerned, at least, and I'm emphasizing that because I'm not sure that the answer is the same for other countries, including Israel, but as far as the US is concerned, I don't think that the basic premise that underlied the earlier paper, which is that capital is more mobile than labor, actually is correct, at least in the narrow sense of what I'm talking about, because when you look at it from the perspective of the public finance literature, this is a formal assumption in the economic models, and the result is that people recommend something like the Scandinavian dual income tax system, in which capital is explicitly taxed at lower rates than labor is. And this is, in fact, to some extent what we have in the United States now, because we now have a 15% rate for capital gains and a 15% rate for dividends. So the suggestion is that these should be extended, because they're both due to expire at the end of the year, and also perhaps that we should have a lower rate for interest as well, which is another form of income from capital, of course. And also, people also say, as we just heard, that the corporate tax should be cut, and all of those are assumed to be taxes on capital. And to the extent that you need to compensate for that by raising more revenue, then the suggestion is we should increase taxes on labor, i.e. the personal income tax, and possibly institute a VAT on top of that. I mean, many people have said that the way to pay for a cut in the corporate tax rate is to have a VAT, although I don't know if that's politically viable in the immediate future. So, why am I saying that I don't think that's right? I'm saying that I don't think that's right for a variety of reasons, but most of them relate to the, by now, 40-year-old debate about whether in general capital should be subjected to lower rates than labor tax, of lower rates than tax and labor. And I'm not going to repeat those now, although I'd be happy to answer questions about them. I mean, this has to do with the whole debate in the US literature about whether we should have a consumption tax or an income tax, because a consumption tax exempts the return from savings, i.e. capital. So that's one literature. Another literature is about whether we should tax capital gains at a lower rate. And the third one is about whether we should tax dividends at a lower rate. All of those are relevant to the question, to the practical question of what we should do, but they're not what I want to mostly focus on. Essentially, the practical issue at the moment is what to do at the end of 2012 when the Bush tax cuts expire and we face the so-called fiscal cliff, part of which is spending cuts, and part of it is the payroll tax, which has already been mentioned, but a lot of it is the question of what to do about the lower rates for dividends and capital gains, and that's part of the argument in the election campaign right now. So the part that I want to talk about is this issue of relative mobility. And my argument is that basically that from that perspective, i.e. from the perspective of escapist taxation, it is not true for the United States to say that capital is more mobile than labor. So how can I say that? Well, first of all, let me explain what I mean. And the first argument against me, of course, and this was a big element in my previous paper and was also something that you just heard from David Shizer, is what about the corporate tax? Because I, of course, don't argue that corporations' income is not mobile. In fact, I've contributed massively to the literature that tries to prove that it is very mobile. And in fact, because of that, I also support, as does David, a cut in the corporate tax rate. I think that we're now an outlier with the 35%. And there are other things that maybe we can do about it, as was just discussed. But I want to put that aside precisely for the reason that David mentioned, or for at least two reasons. One reason is we don't really know very well what the incidence of the corporate tax is. There's a very big economics literature on that. It's inconclusive. There are studies on both sides of the issue. Some people say it's 50% labor. Some people, recently the Treasury suggested maybe it's only 80% labor. But nobody knows for sure. Personally, I suspect that there is no answer to the question. That is, I don't think that there is a permanent answer to the question of what is the incidence of the corporate tax, because I suspect that it depends on things like, as was mentioned, the relative mobility of capital versus labor and the ability of corporations to tell their employees, we're going to open a factory in Singapore if you're not going to stick with the current wages or accept wage cuts and stuff like that. And that seems to be changing over time. Probably in the direction of imposing more tax on labor than on capital, I'm guessing, but it's anybody's guess. But in any case, because of that, I want to put it aside. In addition, because of the ability of corporations to shift their income tax base offshore, my sense is that at least as long as we don't do something pretty drastic about that, that actually is an argument for taxing capital gains and dividends more rather than less, precisely because I think they're relative to the corporate tax base, they're less mobile. And that's what I'm going to talk about less. That is, even if we assume that it falls on capital and not on labor, because corporations can avoid the corporate tax relatively easily, that's a reason to try to tax corporate shareholders in the form of dividends and capital gains rather than not tax them. So let's talk about individuals, which is where the focus of this paper is about. So let's take a look at U.S. individual earners of capital income and ask ourselves the question, is their capital really mobile? Well, of course it is mobile in the sense that, as we know, for example, from Mitt Romney, you can put your capital in many places in the world. But of course the point about Romney, for example, is that he paid tax on every single penny of his investments in the Cayman Islands and in Switzerland and every other place that he put, because he had to. Not just because he's a politician, because that's the law and he's a law-abiding citizen. So the first point, of course, is that under the law, I mean, this is pretty clear, U.S. Citizens and residents have to pay tax on worldwide income, quote, from whatever source derived, unquote, and that includes foreign source income, and they have to pay tax on it whether directly or whether earned through foreign corporations, because if they earn it through foreign corporations, even if they don't control them, those corporations typically would be what we call PFICs, that is passive foreign investment corporations, and therefore there are ways of taxing them on that income as well. So as a matter of what the law says, there's no question that all of that stuff is taxable. Point two, can they easily evade it, that is illegally, by hiding the money overseas? Well, on this one, my view is that it is definitely a diminishing opportunity. I'm responsible probably for the highest published estimate of how much the so-called international tax gap is, that is how much U.S. citizens and residents manage to avoid every year in terms of hiding their money overseas, and I put it at $50 billion. I think that this, as I know only too well that this rests on somewhat shaky assumption, because there are really no published data anywhere. I mean, what I did was that I used data on the offshore holding that of high net worth individuals that were published by Merrill Lynch and the Boston Consulting Group, and guesstimated from that how much income there was and how much it was being underreported. It's probably an overestimate, but in any case, this was before all of this recent scandals and legislative activity. So the first point about the scandals, like the UBS scandals, is that you can only do that as long as some banker doesn't talk. And recently some bankers have been talking. So there was the famous Liechtenstein episode that somebody stole a CD and sold it to the Germans, and then sold it to the Americans, and then sold it to everybody else. So everybody got names out of that. And then there was the whole UBS scandal where UBS actually sent people into the United States to recruit the rich to smuggle diamonds in toothpaste containers because they can't transfer the money. I mean, if you transfer it by wire out of the United States, the banks know about it and you get caught. And if you transfer it by carrying cash to the airport, you run a serious risk because you're supposed to declare it if it's over $10,000, which is a very small amount for these people. So it's not so easy to do. And if you try to smuggle it in toothpaste containers, well, first of all, you need to, there are transaction costs. You need to buy the diamonds, you need to stuff them in, and so on and so forth. But in addition, if the banker talks, then you're still caught. And the Swiss ultimately had to disgorge, and people went to jail. And most of the economics literature that I'm aware of doesn't assume that people are willing to go to jail. This is a little bit of an extreme assumption. And people really do go to jail. Even the whistleblower went to jail. Because he didn't fully disclose, I guess. So that this is serious. And in addition, we now have FATCA, the Foreign Account Compliance Tax Act of 2010, which imposes very severe limitations and penalties on foreign banks that do not fully disclose their holdings of U.S. citizens and residents' bank accounts. And everybody's complaining bitterly about FATCA, which in my opinion is the best indication that it's actually working, because the banks hate it. But what FATCA does is that if you are caught doing that, what UBS did, then there's a 30% penalties on your U.S. assets. And for UBS, this would be a killer. Now, yes, it's possible in theory if you're a U.S. Citizen and resident. This is all assuming people who live in the United States, because otherwise, of course, they would be mobile. But let's assume that you stay in the United States. You can presumably find some bank that has no American assets at all. Even then, as the Iranians found out, it's not so easy to avoid the US financial system altogether when you're transferring money. And you're really running a serious risk. But I just think that it's all a matter of transaction costs. The transaction costs, in my opinion now, to tax evasion in the United States have risen to such an extent that to say that capital is mobile in the sense that we should tax it less because it would run away is for individuals, not for corporations, is simply not realistic. And now let's talk about labor mobility. Yeah, briefly. The assumption in the economics literature and in my old paper was that labor is not mobile because we have immigration restrictions. But how many immigration restrictions do we actually have? Well, in the United States, there are currently 29 million people living there legally who immigrated there, including myself, and another 11 million people living there illegally. That's about over 10% of the population. In the EU, it's the same. It's bigger numbers, but as a matter of the percentage, it's about 10% of the population who immigrated into the EU. So you can't really say that immigration restrictions are that hard. I mean, there are other, of course, disincentives to immigration. I mean, I carry the cost of immigration every time that I'm here because I have to speak in a foreign language, and I have, my family and friends are here and so on, which is why I come here all the time. But nevertheless, I live in the United States, right? So there are costs, but some people, about 10% of the population, are willing to undertake them. But in addition, when we're talking about the income tax and the tax on capital, it's hugely skewed towards the upper echelons of the income distribution. And for those people, I think, first of all, immigration restrictions are almost non-existent because every rich country in the world basically welcomes rich migrants and have all kinds of immigration incentive in order to persuade them to come there. So that's the first point. I mean, Canada and Australia and most of the EU countries and Hong Kong and Singapore and all of these tax havens, they all welcome people to actually come and live there. And in addition, we now have some very interesting data that came out from the fact that in 2008, Congress changed the law on expatriation. Now, if you're an American, it's not enough to move overseas. You have to actually relinquish your citizenship. And that's a public act, and therefore it can be documented. Well, in 2008, Congress decided that too many people were doing that, so they're going to put an exit tax on. So now if you expatriate and you're rich enough, over $2 million, you're deemed to have sold all of your assets, and at that point there's an exit tax. And this is what Eduardo Severin, one of the co-founders of Facebook, is is facing now, except that he expatriated last year before the IPO, so he's going to argue with them about how the value of the shares. But as of the IPO, he had $4 billion, right? So the question is, what was it worth a year ago? But the interesting thing is that the number of expatriates since the adoption of this law tripled. And the reason that it tripled is presumably because, whereas before, for a lot of Americans, it was shameful to expatriate because you're giving up your citizenship, even though you have a citizenship from another country. After that, it's just a matter of financial calculation. And what you do is you compare the current exit tax that Congress imposed versus the present value of the income tax that you're likely to pay, plus the estate tax that you're likely to pay, plus the likely future trend of US tax law, which is likely to rise. And for anybody who lives in Singapore, like Severin, or in Hong Kong, or in any of the places where you don't pay local tax, not in Israel, I don't think, but in any of those places, it becomes a no-brainer. Of course you want to expatriate because you save so much money. And so from that perspective, I just think that the kind of labor that we're talking about when we impose the income tax is just as mobile or more mobile than capital, and therefore the bottom line is the tax rate should be the same for everything, and we should just have the world that Charles Thibault envisaged in 1956. People will choose with their feet. The American public will vote every 4 years what the tax rate is. I mean, they can choose this in this election, whether it will be for, the rich 30% like Obama wants or something less like Romney wants. And for the people who don't like it, let them move. And I would also not tax them even if they're citizens. And, that's fine. And then they don't get the services from the American government. And for other people, let them live with their choice. And